All right, let's get right into it. Welcome to The Explainer. Today, we're putting on our expert investment analyst hats to run a fundamental health check on an absolute consumer defensive powerhouse. We're talking about Coca-Cola Europacific Partners, or CCEP for short. We're going to examine this company straight through the lenses of legendary investors. We'll be evaluating economic moats like Warren Buffett, hunting for stalwarts like Peter Lynch, and checking for a margin of safety just like Benjamin Graham. We really want to see exactly what makes this company tick, how it generates its cash, and what Wall Street expects from it going forward.
Here is our roadmap for today. We'll kick things off with CECP's sheer scale, gauge current market sentiment, and break down their shareholder returns. Then we'll analyze their credit health, unpack their highly financially driven sustainability strategy, and wrap it all up with our final verdict.
Section 1. CCEP, the bottling giant. Let's establish exactly what kind of scale we're dealing with here.
To put it simply, CCEP is the single largest bottler by revenue in the entire global Coca-Cola system. They're not just playing in a few local markets. They are actively serving nearly 600 million consumers across 31 different countries, from Great Britain and Germany all the way over to Australia and Indonesia. It's a massive multinational operation that pairs global scale with localized market execution. Now, if we look at this through a Warren Buffett lens, this is your absolute textbook economic mode. They make, they move, and they sell the products. They act as this highly defensible, totally irreplaceable bridge between the Coca-Cola Company's iconic brands and the actual consumers holding the drinks. So how is all that massive scale actually translating into top-line growth? Well, their recent Q1 trading update showed revenue up a very solid 6.7%. That was driven by a smart mix of strategic pricing, a favorable product mix, leaning into those premium offerings, and an early Easter bump. But let's apply Peter Lynch's framework for a second. Lynch loved what he called stalwarts, these massive stable companies that somehow still find pockets of fast growth. For CCEP, that primary growth engine is the Asia-Pacific region, or APAC. Following some huge acquisitions like Coca-Cola Amatil and the recent consolidation in the Philippines, Fitch actually expects this APAC region to drive roughly 28% of the group's total revenue by 2025. They're deliberately pivoting toward markets where consumer demand and purchasing power are growing the fastest.
Section 2. Market sentiment and forecasts. Let's see how Wall Street analysts are interpreting all this growth.
Just look at the sheer level of consensus here. Based on the latest data, we have 11 major Wall Street analysts actively tracking CCEP. Out of those 11, 8 rated a buy, 3 say hold, and there is exactly 0 sell ratings. None. 0. In a market where analysts are constantly disagreeing, seeing a uniform moderate buy consensus with a complete absence of bearish sell ratings, that is a remarkably strong indicator of institutional confidence.
And that consensus translates directly to an average 12-month price target of $107.88. So at the stock trading around $104 at the time of this data, you're looking at a forecasted upside of about 3.64%. Now, sure, a DCF model for a hypergrowth tech stock might project wild double-digit swings, but remember, CCP is a classic Peter Lynch stalwart. You're not buying it hoping for a 50% overnight moonshot. You buy it for that steady, predictable upward trajectory, which, when you layer it with reliable dividends, creates serious compounding wealth.
If we analyze the risk profile by contrasting the absolute most pessimistic Wall Street forecast, which is $93, against the optimistic high of $115, we see a really tight band of expectations. To use Benjamin Graham's terminology, this predictable floor offers a fantastic margin of safety. The downside risk that analysts are modeling is strictly contained, and that just further cements CCEP's status as a highly stable equity.
Section 3. Shareholder returns. Speaking of predictable wealth, let's talk about how management is actively rewarding its investors.
We all know dividends are the absolute lifeblood of a defensive portfolio, and CCP delivers a very reliable 2.3% dividend yield. But the really crucial metric here is their dividend cover, which sits comfortably at 2.0x. What does that mean? It means the company's underlying owner earnings are safely covering that dividend payout twice over. It's a highly sustainable 50% payout ratio. And that right there is exactly why they've been able to deliver consecutive annual dividend increases for 6 straight years.
But dividends are only half of the story. CCEP is also aggressively returning capital through a massive €1 billion share buyback program. They announced it back in February, and they've been actively executing on it, including some major repurchases in mid-July handled by Goldman Sachs. Think about it. When a company with CCEP's scale starts retiring up to €1 billion worth of its own shares, management is sending a very loud, very clear signal. They firmly believe their stock is trading below its intrinsic value, and they know their free cash flow generation is exceptionally strong.
Section 4. credit health, and leverage. To sustain those dividends and fund billion-euro buybacks, you absolutely need a pristine balance sheet. Let's look under the hood.
So, Fitch Ratings recently upgraded CCEP's long-term issuer default rating, which is basically their corporate credit score, to an A with a stable outlook. This places them firmly in investment-grade territory. However, to be totally objective, it is worth noting that when you compare them to regional peers in the Americas, like Arca Continental and Coca-Cola FEMSA, CCEP sits just slightly lower, as those peers carry solid A ratings. The primary reason for that minor divergence? It comes down to their leverage profile.
Fitch expects CCEP's net leverage to drop to an optimal 2.8x by 2025. That means their total debt will be just 2.8 times their annual earnings. So while it's slightly higher than some of their peers, it proves their balance sheet is still highly resilient, and it's heavily supported by a projected 1.3 billion euros in free cash flow. They can easily service their debt while still fully funding those massive shareholder returns we just covered.
Section 5. Sustainability as a strategy. Let's explore something that I think gets misunderstood a lot. For CCEP, sustainability isn't just about environmental compliance, it's literally a tangible financial strategy.
Take a look at this quote. During a recent company webinar, Joe Francis summed up their approach perfectly. He said, "Every sustainability initiative is assessed because we look at impact, we look at feasibility, we look at cost, and we look at deliverability." Management takes a highly pragmatic, incredibly financially disciplined approach to green investments. They deliberately pass on projects where the environmental benefit is tiny or the economics just don't make sense. Everything has to drive long-term value for the business.
What they're doing is actively searching for what they call the sweet spot, that perfect intersection where reducing emissions directly improves operational efficiency and strengthens the overall P&L. For example, they are keeping a very close eye on new deposit return schemes, like the ones that just launched in Portugal and are coming soon to the UK. By reducing water and energy usage in their bottling processes, they aren't just cutting carbon emissions, they are significantly cutting their overall operating costs. It is not just a green initiative, it's a defensive economic moat built entirely on operational efficiency.
Section 6. The final verdict. We've looked at the operations, the cash flows, the debt, and the strategy. Now let's synthesize all this data into a clear, impartial final verdict.
The bull case for this bottling giant is pretty undeniable. When we evaluate it through our guru frameworks, you have a company boasting a massive economic moat, literally 0 sell ratings from analysts, and phenomenal free cash flow generation. That cash is directly funding a safely covered 2.3% dividend and a billion-euro buyback program. Plus, their growth is strategically locked onto the expanding APAC region, and their financial foundation was just validated by that upgraded A credit profile from Fitch. It's basically a cash-generating machine.
But as objective analysts, we absolutely have to weigh the bear case too. CCEP is navigating some tight inflationary pressures right now, especially around key commodity costs like sugar as well as labor. Their net leverage, while totally manageable, is still slightly higher than regional peers like FEMSA. And fundamentally, their entire economic moat relies heavily on 10-year bottling agreements and deep strategic ties with the Coca-Cola Company to maintain that market dominance.
Which leaves us with one final thought to ponder. The data reveals a company operating with immense global scale, a disciplined approach to intrinsic value, and a massive commitment to returning capital to shareholders. With a safe 2.3% yield and a rock-solid investment-grade foundation, you really have to ask yourself, in a market completely full of volatility, is CCEP the stabilizing stalwart your own portfolio needs right now? Thank you so much for joining me for this explainer, and I'll catch you next time.